Tony Calloway, your private money godfather, here with a real short video explaining a term that if you're a real estate investor, you need to become familiar with. It's one of these things that kind of pops up to bite you sometimes if you think you got a good deal, but it's something that you can reasonably calculate in advance and know if you be able to qualify for financing and how that might affect you. And that is debt service coverage ratio, DSCR is the abbreviation. Sometimes it's truncated to say debt coverage ratio, or DCR. But the bottom line is, what is this term? What is DSCR, DCR, debt service coverage, debt coverage ratio? Well, it is the amount of rental income that exceeds the mortgage payment by a percentage, by a ratio. All right, the rule of thumb ratio that gets you in is 1.25. To illustrate 1.25, let's say that the financing, the PITI, principal, interest, taxes, insurance payment on the property that you're acquiring is going to be $1,000. All that principal, interest, tax, insurance payment per month is $1,000. Now, to hit 1.25 on your debt service coverage ratio, that means your rents need to be $1,250. $1,250. So that's 25% more, 1.25 of the mortgage payment. Very, very simple math. Some lenders will let you get by with less. Very few require more. But now here's the effect. More gets you probably a lower interest rate because there's less risk. Less to whatever the minimum is probably gets you a higher interest rate as a way of offsetting risk. But I would tell you to please plan on 1.25. Now, with that, all that being said, here's another thing that again can bite you. And I hate people to get bit after they paid for an appraisal, okay? And that is, you need to know what the market rents are in your area, okay? Because you might be buying a property where you think you can get more than market rents. You might even have inherited a property where it's already, rented, leased, and the rents are more than market rents. But generally speaking, when the appraisal is done, the lenders more often than not are going to go with the market rents. That's what the average person is paying for a similar house in that area. So for your planning purposes, because like I said, the gotcha, the booby trap is an appraisal gets paid, you don't. Okay, so you can research and find out what the market rents are in your area. And if you got a better lease deal with your tenant, wonderful. If you can get more than that, wonderful. But for the lender, the financing, they're going to look at 9 times out of 10, predominantly is what the market rents are for that property. So that's debt service coverage ratio, DSCR. Sometimes it's shortened to debt coverage ratio. Remember, you need to have 25% more coming in than you got going out. That's at 1.25, and that's going to help you to make sure that you get a good deal that can close, get financed, and all that for your growing your rental income portfolio. All right, so this is Private Money Godfather. You can get in contact with us to power your real estate investing dreams with private money by going to privatemoneysyndicate.com. privatemoneysyndicate.com. Schedule a consultation. Let us take a few minutes to get the details on your project, and then we'll get the money for you so you can start growing your rental portfolio. Private Money Godfather out for now.